Let's move on and let's put the spotlight on auto ancillary and the tire major CEAT, because the company did come out with a strong set of numbers this time, and operationally the company has done well. But what's the way forward and what is the demand prospect looking like? Let's decode that with Mr. Kumar Subbiah, who's the CFO of the company. Hi, very good morning, Mr. Kumar, and thank you so much for your time. Firstly, let me start with the export outlook, particularly in the United States. I do know that it's been one of your recent forays in the major way. There's been an acquisition done, but there's a lot of curiosity with respect to the tariff and its impact. Help us understand that what kind of a sentiment are you picking up on the ground, especially when it comes to the US market, and how is CEAT progressing and shaping up there?
Good morning. First of all, thank you for having me on your program. Just to give you a context, US is at this point in time less than 5% of our revenue. So therefore, any impact on account of change in tariff in US with respect to exports from India would have a marginal impact on us at a very high level. But having said that, we are focusing on US markets. In the last 12 to 18 months, we launched our passenger car radial tires and truck and bus radial tires in that market. Even for our specialty tires, that is farm radial tires, US is an important market. Okay, at this point in time, relative to other countries, okay, India doesn't have any disadvantage in the sense that there could be an advantage over some of the Southeast Asian countries and China with respect to tariff. And the originally tariff was announced. The relevant tariff for us is about 26%. Okay, whereas in all the Southeast Asian countries like Vietnam, Thailand, even Cambodia are at 30% and 40% higher than Indian tariff, in the sense that 40% plus is applicable tariff for Southeast Asia, and originally they had announced China as 36%. So therefore, relative to other countries, India may not have any disadvantage as far as tires are concerned. But today, when tires are imported into India, it attracts about 15% duty. And in the US, prior to changes in tariff, the applicable tariff was approximately about 5%. So the difference is about 10%, okay, which is not a big difference. If the current 10% continues above the existing tariff, there is a parity in terms of duties on tires between these two. We are assuming Indian government is engaging very well with the US. So if you are able to find some kind of a structural solution to it, this could be a plus for Indian tire manufacturers.
But Mr. Subbiah, your guidance in the past has pointed to double-digit growth in exports. Do you think that that's going to continue, and is that the outlook that you maintain? And also, what's the current growth trajectory that you're working with when it comes to the domestic market?
No, we continue to focus on international business. Okay, and as we had communicated in the past, our share of exports business on our revenues currently hovering around 20%. Our endeavor is to take it to 25% in a 2-year kind of a time frame. In the year that went by, in FY25, international business grew by about 8.5%. Okay, going into the current year, we do see double-digit kind of a growth. Overall, CEAT grew in double digits in full year, and also in Q4 we grew by about 14%. We would like to see some momentum in the international business from the current quarter. We had some challenges in the previous financial year with respect to availability of vessels, availability of containers on time. That had some impact on our revenue, but otherwise we grew strongly at 8.5%. We look forward to a double-digit growth in FY26.
All right, but along with that, Mr. Subbiah, we have seen a sequential improvement in your margins and specifically gross margins. Can we expect this trend to sustain in the coming quarters? And along with that, what's the outlook on the raw material basket going forward?
No, look, in Q4, our gross margins moved up largely on account of mix and small drop in raw material prices versus spot. So this was a sequential improvement. And we also focused a lot on a lot of other elements, cost elements, like supply chain, looking at manufacturing costs, looking at efficiencies in claims, scrap, energy, and things like that. Okay, at this point in time, we are seeing some kind of small correction in commodity prices, particularly in the international natural rubber prices have corrected by about close to $200 in the last 3 weeks' time. Okay, and so international prices were at a premium to Indian rubber prices to the extent of about 15 to 20 rupees per kg. Currently, it is at a discount to local prices in the range of about 8 to 10 rupees per kg. And that's one positive development. And more than half of the natural rubber that Indian tire industry consumes in the manufacture of tires is imported. So therefore, it should have a positive impact if it sustains. Number two, crude has been largely hovering around $65. So therefore, crude derivatives like butadiene, caprolactam, and CBFS, which is a feedstock for carbon black, we hope those prices react in line with the crude in the coming months and in the next quarter or so in terms of its impact on our research. So we see it as a positive development. As far as current quarter goes, we expect raw material prices to be largely in line with quarter four, maybe a percentage lower than quarter four. But if the raw material prices sustain at current levels or if we see a downward trend, possibly it may have some favorable impact beyond quarter one.
Right. Mr. Subbiah, just lastly, I have a couple of other questions. Segment-wise, tell me how the demand is shaping up for you. Where is it that you're seeing the strength and weaknesses? And also how replacement demand is panning out?
Okay, for FY24-25, and the growth largely was led by replacement segment for us, which is more profitable than other segments. So therefore, from the beginning of last financial year, month on month, quarter on quarter, replacement grew by double digits year on year. So there is a momentum at this point in time with respect to replacement. With respect to us, considering that we also added truck and bus radial tire capacity in the middle of last year, that will also help in terms of utilizing that capacity in replacement. So we see a mid-single digit kind of a growth possibility in the coming year. And we hope, in addition to that kind of a volume growth, we hope to get some price growth with premiumization and with some selective price increases. We hope to see a double-digit kind of a growth going into FY26 on overall at revenue level.
Well, I just wanted to ask on the price increase as well, Mr. Subbiah, because I remember that in the last couple of months, especially at the start of this particular year, the company did undertake select price hikes. But what is the outlook for the upcoming months? Maybe in the next 2 to 3 months, are you planning to take more of the price hikes, and in what range it could be? Any indication will help.
No, broadly, if you segregate Indian business into two, one is, say, replacement business, which you mentioned recently. Replacement price increases have been happening steadily in small percentages. Even in quarter four, we did take some price increase in two-wheeler categories as well as in passenger car during the course of quarter four. So it will have a full quarter impact in quarter one. With respect to original equipment manufacturers, approximately 70% of our contracts are all on price adjustment basis. So with a 1 quarter lag, we do adjust our selling price to the extent of movement in raw material prices. So there is a natural effect with respect to prices as and when raw material prices move up or down. If raw material prices correct, okay, but our decision, maybe we will go little slow on price increases, but to make sure we get back to 40 to 41% kind of a gross margin level, it is important for us to use the lever with respect to bringing our cost down and also selective price increases over a period of time. So if raw material prices stay at current level, you will see more price increases in the coming months.
Interesting turn of events. Mr. Subbiah, great to have you on the show today. Thank you so much for your time.
Thank you. Thank you. Wonderful talking to you.
If you like this video, then like, share and subscribe to ET Now.